Are we going to have a recession? Is inflation going to infinity? Stagflation? There's so many voices out there saying so many things, but how do you figure out the good takes from the bad? What happens if everybody's wrong? Here's my take. I think that economic growth is going to fall sharply at the second half of the year, sharper than people expect. And maybe that changes the equation for the Fed. I think inflation is going to ease off quite sharply too. But I've been in markets long enough to know that we all get it completely wrong sometimes, and I could be dead wrong. There's a lot going on. So I just wanted to pick your brains, see how you're seeing the world. So give us your big picture view, and then we'll start digging into some stuff as we start chatting.
So I think kind of like how COVID-19 accelerated a lot of trends that were probably already going to be in place anyway, I think the recent military conflicts we're seeing are kind of accelerating some of the problems that were already mounting. And so, for example, we already saw Europe have some energy issues even before any of this conflict broke out, and some of that was now accelerated. I think same thing for food insecurity and things like that. And essentially, I think what we're seeing is a slow kind of unwind of the global monetary order that's been around for the past 50 years or so, and moving towards a more bifurcated world, where we have maybe a little bit more decentralized payment channels, maybe more decentralized choices of storing value, as well as supply chains themselves becoming more bifurcated, because we're seeing, food protectionism, commodity protectionism, commodity, different sort of trade happening around these more like alliances rather than in a global market.
Do you think that, I completely share your view on that. What I'm trying to figure out is whether this is creating a step change in inflation, i.e. the trend of the last 30, 40 years is gone, or whether demographics, technology still kind of trump out in the end, and this is a temporary structural shift we're seeing, which is generating this.
So I think, most inflation is transitory, but transitory can last for years in inflation's case, right? So the 70s were transitory, but it was, it was long enough that, it wasn't really transitory in terms of a trading perspective, an investment perspective, a lifestyle perspective. And so my base case for a while has been that the 2020s would be more inflationary than the 2010s. The exact height that we were going to reach depends on these variables that are hard to predict ahead of time, like whether or not there'll be war, whether or not there'll be factors like that. And so I think now we're at risk of hitting some of the higher levels of that kind of range, that probability range that I think was going to play out anyway. And now we're kind of on the higher side. So I would characterize this kind of like the 70s or the 40s, in the sense that we are going to probably have a pretty persistent amount of inflation. But even then, it won't be a straight line. If you look at the 40s, you had price controls at some point. 70s, you had, price controls, you had wage controls. There are periods where even in an inflationary decade, you can have disinflationary periods, right? So you get these waves of inflation. And I think the 2020s will be no different, where you could get, for example, a de-escalation of some of the big trends we're seeing now. Things can be overdone, traders can pile in, things get to consensus, and then there's some sort of kind of unwind of that, and then you can have another spike up. We've already seen this happen in European natural gas, for example. There were periods where it got overdone, came back down, and then got even more overdone. And I think you could have the same thing on kind of a longer trend line. So I do think that if you look over the past 25 years or so, historically, money supply and CPI, if you use, say, 5-year rolling periods rather than the noisy kind of year-over-year period, there generally is pretty strong correlation, but there are periods where you can have a pretty significant disconnect, and that's usually due to some rapid technological change. We've unlocked some new abundance that allows for, less inflation than you'd expect from the money supply growth. And so that happened, for example, in the late 1800s. You had the invention of the internal combustion engine, you had electrification, you had the discovery of oil. The United States had nearly unlimited land, and so that was abundance. And you kind of had a similar thing over the past 25 years, where we unlocked so much global labor, and corporations were able to do a lot of geographic arbitrage, that you've had a disconnect between, say, money supply growth and wages domestically in many countries. And so I think that particular force is probably coming to an end, at least for a period of time, because I think we've kind of squeezed a lot of juice out of the globalization orange, and that now we might have hit kind of peak globalization, meaning that we don't unwind globalization necessarily, but we could stop accelerating globalization, and all else being equal, that should be more inflationary.
One of the things I'm thinking of is I've been thinking that the 1940s is probably the most similar period, less so the 70s. It's the post-war. It's kind of the same kind of structure we've got now. GDP was volatile. inflation at first took off and then kind of eased over time once, we started to see manufacturing pick up and all of that. We saw yield curve control. We saw a lot of fiscal stimulus.